In this video, we're going to discuss the difference between actual and applied manufacturing overhead. So if you remember, manufacturing overhead consists of all the manufacturing costs other than direct materials and direct labor. So it's basically a bunch of indirect manufacturing costs. And companies will track the actual manufacturing overhead as it is incurred throughout the period. So for example, if they have real estate, property taxes on the factory, stuff like that, they will make journal entries to record the actual manufacturing overhead. However, companies also will determine, they'll have a predetermined manufacturing overhead rate that they figure out at the beginning of the period. They might do it based on machine hours or direct labor hours. They basically take all the budgeted manufacturing overhead for the period, and then they divide it by this activity base, and they come up with this rate. Okay, and then they apply it throughout the period. It's a little easy to understand with job order costing, but it's also done with process costing as well. Think about it like this. When you're trying to cost out a job and say what's a per unit cost, you don't necessarily know what the manufacturing overhead is going to be for the period yet, so you can't actually take the actual manufacturing overhead and apply it to the job. So what companies do is they use this predetermined rate. But then we have this issue because we have a difference. What if the actual manufacturing overhead is different from the applied manufacturing overhead? And that's very likely to happen, and there's a couple ways to deal with that. But first, I want to get into the basic mechanics and show you some journal entries of how actual and applied manufacturing overhead can be different. So let's say that you have a company that manufactures giant rubber ducks. Okay, so this is your product here. You make these giant rubber ducks and you sell them. So you use $500 of indirect materials at some point during the period. And so because it's indirect materials, it's going to be part of manufacturing overhead. So the journal entry you would make is you would debit manufacturing overhead for $500, and then you would credit raw materials inventory, because we are talking about indirect materials here. So they're a type of raw material. So you would reduce the raw material inventory account as you take those the raw materials out and use them. But because it's indirect materials, you would debit manufacturing overhead. So whenever this is actual manufacturing overhead here. Okay, so whenever we do with the actual, we're going to debit it. Now, let's say we have a situation where we have indirect labor. So a janitor is cleaning the factory. So that's not something that's clearly traceable to the final product that we're making because it's the janitor's wages. It's not directly traceable, so it's not direct labor. So that's going to be manufacturing overhead. So again, because this is the actual manufacturing overhead, what we're going to do is we're going to debit manufacturing overhead for $800, and then we're going to credit cash, assuming we paid the janitor cash for $800. Now, if you're wondering, what about the applied overhead and everything? Don't worry, we'll get to that, and we'll set up a T account, and I'll show you how it all works. Basically, manufacturing overhead is going to work as kind of a clearing account, and I'll show you all the mechanics of that. But I'll just give you one more example. So now let's say that the company has, they get an electric bill for the factory of $700. Now they would debit manufacturing overhead for $700. Again, this is actual manufacturing overhead, and then credit utilities payable, assuming they just got the bill, they didn't pay the cash. So I have three types of actual manufacturing overhead here that were recognized. In each case, we debited manufacturing overhead. Now, let's say that we go and actually apply. And again, when we're applying the manufacturing overhead, we're talking about using that predetermined overhead rate. So this is not the actual here. Now we're saying we're going to apply manufacturing overhead. We're going to apply $1,800. I don't want to get into what the rate is and stuff because we got other videos. I don't want this to be too long. But we have a predetermined overhead rate, and then we apply the overhead, and it results in $1,800 of overhead. So now what we do is we credit manufacturing overhead for $1,800, and we debit work in process inventory. This WIP inventory account is where these costs go. So interesting. If you remember, you think about the cost flow through an organization that's a manufacturer. You got raw materials inventory, then work in process. Then work in process ultimately goes to finished goods, and then cost of goods sold when it's sold. Here, we're taking the applied manufacturing overhead, and that's the one that is the corresponding entry for the work in process inventory. Now, you might have noticed that there's a difference. We have 500, 800, and 700. If we add that together, that's 2,000. But we only applied $1,800 of inventory. And I'll make that a little more clear for you with a T account here. So if we think about all the debits and credits of it, we have 500 debit, 800 debit, 700 debit, but then there was a credit just for 1800. So if you add this up, we basically have a debit balance as the ending balance of manufacturing overhead. What does this mean? And we would call this an underapplied overhead balance. It basically means that, look, the actual manufacturing overhead for the period was $2,000. It was $2,000 a man. But based on our predetermined rate that we used to apply overhead, we only got to $1,800. So we didn't apply enough overhead. That's why we say it's underapplied. You could easily have another example where you applied too much manufacturing overhead. And there are a couple ways we can deal with this. One is we can basically close out the under or over applied balance by making a journal entry with cost of goods sold. And another way is we can prorate this among 3 different accounts, among cost of goods sold, work in process inventory, and finished goods. We can prorate it among the 3 accounts. And we'll talk about those methods in the videos to come.